Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I'll be your host today. Well, I guess depending on what trade that we looked at, the official paper trade was an open wing butterfly to the upside on Palo Alto, and the stock the concerns were warranted, right? We talked on the show about buy the rumor, sell the news. And we did see that play out in that they announced earnings, had a very strong earnings, actually initially went up fairly strong to the upside, and then sold off by the end of the after hours trading session, sold off pretty hard. And we're seeing that continue into today. Right now, we see the market is down 6.5%. Down $18.73. Now, the good news about our open wing butterfly is that we had with all the volatility that was in the stock, we were able to do it for extremely cheap. And so there's not much left of it. We did a short-term trade. It didn't pan out. And whatever you put into it right now, I checked the trade earlier where it's trading for about a dime. So I think I'd rather just let it play out because of the volatility. That's very possible the stock could make a move back before Friday, and you say, I don't want the cheese anymore, just let me out of the trap, right? I'll be happy to take it. But if you did the skip strike butterfly, which I think I'm going to lean to those with these stocks, and those trades have been working out for us on stocks that have had a huge parabolic move to the upside, which nowadays used to be, if you were watching the financial shows, that most of the time you'd only have one or two stocks, but now they have so many of them, it's hard to address them. And that's thanks to AI. All the semiconductors are going crazy. The next one is Broadcom. Broadcom right now is up 1%. Trading at $487.28. So Palo Alto, I guess, didn't work out. If you looked at the open wing butterfly, if you just got flat out bullish on Palo Alto, it did not work out. If you leaned into the skip strike butterfly, which once again, I've always emphasized this is an alternative to a short call spread, which is a bearish trade, then that trade worked out just fine. And as a matter of fact, you put the position on and you can hang around until Friday to see if the stock comes back. And at this point in time, the implied volatility is out of it. You could capture the entire net credit that we did the trade on, that we established the trade for. And I think I'm going to do the same type of trade in Broadcom. So AVGO is the symbol. And let's run to the Trader Pro software. And let's look at the charts. We'll start out with the chart here in this instance, AVGO. And we'll zoom in a little bit. Okay. Let's go a little bit more. Here is the run up. Now we've had 1, 2, 3 days, and then we've had a couple of down days. I don't necessarily, they're not down days, but in that they finished on the down. We didn't have the nice strong white candle where we finished near the highs. We're finishing near the lows at the end of the day, but the stock still continues to make new highs. We're in the semiconductors. The strength is there. Yeah, I'll give you the options again, but this time I'm going to make the official paper trade, the skip strike butterfly. That's the trade that we're going to look at. So we have exactly 2 days. So I feel better about the skip strike in this case because they're going to announce after the close today. And then you're going to have all day Thursday, all day Friday before the option contracts expire. There's not that extra day of trading. And if we do that, we get all the vol. All the vol has to come out after earnings, or it doesn't have to, but it usually does. And then you have to make it through the 2 days before it blows through the strikes to the upside. So we'll go more than a 1 standard deviation move to the upside, and we'll sell a short spread against our position. So let's do that. We'll sell the short spread to pay for the butterfly, which will make us a skip strike butterfly with calls. So inside the options playbook, if you go to optionsplaybook.com, in the search bar, you actually type in skip. You will be offered those selections, skip strike butterfly with calls or puts, and you can review what the profit and loss graph looks like inside the options playbook. All right, so if we want to, and I'll do this, but we'll look at the buying the at the money call and look at buying the at the money put, and we'll start there. That's a 44-point expected move. We'll round it up to 45. So if we look at that, that's usually about where the 20 delta is. So a lot of times I'll skip that step and I'll just look at, well, the expected move is probably where the 20 delta is at, and 20 delta is all the way up here, 545. So a little less than that, I guess. In this scenario, I'd say 540. We got 45 points, 545. So we'll center it right around this level, right at the 20 delta. So to get all the way up to a 1 standard deviation move, which is about a 16 delta, there's a lot of open interest on that, right at the 560 level. Odd to see no open interest just right at that one level. And that was okay, that's because it's a 510 strike, and they must have recently opened up these strikes because, it's near an all-time high. So they're putting the 2.5 strikes in, and they used to have the 550s and the 560s. And it's very obvious to see that because every 10 points, there's a lot of open interest. And that's the standard on an expensive stock. 10-point strikes is very common to have, but obviously heading into earnings, they opened up some more strikes, and now you have 2.5-point strikes to play with too. June 5th expiration, 2 days away. Let's buy 47. Oh man, we can go. Go that far out. 10 points. Let's stick right at let's try the 550s. We sell 2 of these. Can we go $5 here and buy this? Too many legs. 1 second. If we can go 10 points wide and get it done for a decent credit, that would be awesome. Stick right where the open interest is at. It's going to be, the markets are tight anyways, even on the 2.5-point strikes, but we're fine. 550, sell 2 of these, and then 570, 580. See where we get. $0.57 net credit. We have $1,000 worth of risk on this. I'd like it to be $1, but that's not bad. We're way out of the money. We're trading the round strikes. We're 11. It's saying right now there's 11% chance based off of volatility, but we obviously have the huge event, which ups the probability of it happening on the 580 strike. But the delta is 11, saying there's a 10% or 11. We'll just call it what it is, 11.28% chance that this option contract would finish at least 1 cent in the money by the expiration date on June 5th, the close of the market this Friday. Yeah, there it is, 75. I mean, I'd work it. If you get 75 for this, I like it. Okay, so I'll go back and I'll look to explain it. I'm going to send it to the trading floor at 75, and let me give you the read back. Then scroll up to the top here. There we go. Okay, so Broadcom, symbol AVGO. It's trading at $487.15. It's up 1.16% today. We're going to go about a 1 standard deviation move out of the money. The company is announcing earnings after the close today, and we're going to buy the 550 strike call, sell 2 of the 560 strike calls. Now, on a standard butterfly, we would buy the 570. We're going to skip that and we're going to buy the 580. That will embed the credit spread inside the butterfly, which would pay for the standard butterfly. So once again, this is an alternative to a short call spread. We're seeing this trade right now. Well, we saw it trading at 75-cent net credit. I'm going to send that to the trading floor at 75 cents. It popped up there just for a second. I'm okay with getting 50 cents, though. I would go down as low as 50 cents on this trade, but let's send it to the trading floor at 75 cents, and we will adjust it before the end of the show. So boom goes the dynamite. Order has been sent. All right, so now let's explain on our Broadcom. I mean, we really got 148 vol. The vol is through the roof. The standard volatility is 63. When I say that we're looking at an alternative to the short spread, buy one, sell two, buy one, we're skipping the 570 strike. So if you sell the 570 strike and you buy the 570 strike, that would be very similar to doing a short spread and a standard butterfly. So I want to look at what this credit is. 48 cents. I think you're going to have to work it at 50. I don't think you're going to get that 75. It was there just for a second. I don't think the market's there. But we're going to go in, and then we're going to clear this out, and let's look at now. Let's send this to the what if calculator so we can go back and talk to it. And let me look at the short spread. So the alternative trade is the short spread, where we remove this leg. This leg would go away. The alternative trade would be the short spread to have a similar type risk. Hit the bid on the 570. We're bringing in 58 cents there. $1.10. No, we haven't really moved. Yeah, it's going to be hard for us to get the other trade done for a net credit of 50 cents if this is only trading for around, well, we'll call it 65. It's usually about double what the credit would be. So like if I can get 50 cent net, if I can get a 50 cent net credit for the skip strike butterfly, normally I would be looking at getting about $1 net credit on just the standard butterfly. But we got 50 cents there. Let's go look at the what if calculator. I don't know if we can get that filled. I like it though. I like the trade a lot. Inside the paper trading app, I'm going to adjust it. I'll probably go down to 25 cents. See if the market gives me that 25 cents. Here we're buying the 560, selling two, or buying the 550, selling two of the 560s and one of the 580s. We're going to send that to the ticket. Saying a net credit of 60 cents right now. Yeah, I don't think we can get that done for that. But here's the way the trade looks. So I like this one better. And Kurt, good morning, Kurt. I see you didn't trade Palo Alto this time, it looks like. Is that what we're stating? And if you would you have done the open wing butterfly, or would you have done the skip strike that we mentioned? I kind of talked myself into the skip strike at the end of the show, but man, the stock was strong. In this instance, we don't quite have the same chart, and that makes me a little bit nervous. We obviously had a strong breakout. Boom, boom, boom. I mean, this looks like a wall more than it looks like a chart. But that was very true with PNW. That was ridiculous. Boom. And now we're getting a little bit of a sell-off. So the sell-off isn't a surprise. AVGO, though, isn't quite as dramatic. All right, this is going to be the official paper trade. 50 cent net credit. Let's look at the order here. Let's adjust this trade. And I'm froze. Just for a second. Let's go back. Then while we're waiting, let's see if we can get back to the what if calculator. 60-cent net credit. I'm going to adjust it. I'm going to toss it in there at 25 cents. See if the Trader Pro paper trading app would fill it at 25 cents. It's fairly realistic in the markets, but you're never going to get you might get a midpoint fill in the real market. The paper trading app is not going to give you that. It's trying to be, it's going to be overly conservative is a better way to say it. Okay, so let's change this to 25-cent net credit. It's saying the mid is 45 cents. We got 3 options going on. All right, we're going to replace that order. Order has been replaced. And while I look at this, and I'm going to set up one more butterfly. Let's look at the open wing. Let's look at the open wing. It's hard not to be bullish on anything that's in the semis. And while I'm doing that, really surprised to see how well Dollar General did after their earnings. And it was, I guess, a strong move on the consumer side of things. And we're down a little bit today. Man, they had a good earnings report, and they had a good forward forecast too. Ah, there we go. Look at that. That filled. Yeah. Okay, so that filled at 25 cents. So I'm fairly positive that we could get a fill at 25 cents. So I think 50 cents is in play. I'd take that 50 cents. I'd start at 75, whittle it down, but my goal would be somewhere. I don't want to go much below 50 with this type of risk. So you're going to have $9.50 worth of risk. You're trying to make that 50 cents. You could make as much as 1,000 if the market opens up and stays below the 560 level. And I'm kind of all over the place, so I apologize with that. So right here is the 560 level. Right here is where the stock is at, $487.32. This is the profit and loss graph as of right now with all the pumped up implied volatility, 148% implied volatility. But what will happen is once earnings come out, the volatility will come out, and this will start drifting towards that precipice of the butterfly. Now, they announce on Wednesday. This would be more interesting if they announced on Thursday, because then all you really have is half a day of time decay that you need, and then you're fairly safe on the upside. But now we got 2 full days. So this trade is, I use the term schizophrenic, in that it starts with a negative delta skew, and that if the market goes up, we lose money because the delta is negative. And then eventually, as expiration approaches, we'll move this line will move a little bit, and then we'll go one more day. This will be 11 o'clock on Friday. And then all of a sudden we're here. And then by 4 o'clock, 4 more hours later, it's got to go. This profit and loss graph goes from here to here. So if you make it until then, now it's just, why not hang around to see if it lands somewhere in this area? And always the rule is that if it hits 560, we get out. Now, you could get a gap opening of more than one standard deviation move. That is possible. You could gap opening all the way up to the 580. Then you just close and you move on. You just don't want to take all that risk, because you're risking $950 to try to capture that 50 cents. But if you go all the way up to here, this is where your risk is at. You get a lot of buffer until you get till Friday. So the upside is that if it does blow through the strikes, that volatility helps you until it comes off. And then at expiration, this is the graph. Right. Any other questions that anybody has? All right. I like this trade better than the Palo Alto trade, but just because Palo Alto, the chart was just crazy. But the downside is that it isn't quite as strong of a move as we saw in Palo Alto. If you wanted to get bearish, it was easier to get bearish on Palo Alto than it is right now on Broadcom. And also in the semiconductor space versus the cybersecurity space, it's a different world. Now, Dollar General came out and had really good earnings, and I'm gonna read the report. And this is a good sign for the consumer, except for you could say that, well, it's not good that Dollar General, that people are trading down to Dollar General. But that said earnings report, a 12.4% increase in earnings per share, exceeding estimates despite a slight revenue miss. But they also came out and raised guidance. So yeah, real strong revenue growth. Earnings per share $2 per share, 12% increase. I was trying to see where the estimates were at. But I'm once again, buy the rumor, sell the news, right? So now the stock is down today, down about 3.5% at 102.49. I don't like Dollar General. It's trading right now at a PE of 14 times earnings. I'm going to do a longer term trade in Dollar General. I don't think it's going much lower, and I wouldn't mind buying it in our paper trading portfolio. So here we got vol. We have vol. We still have a lot of vol. Earnings came out very positive right here. This I guess is our downside, right about 95. 1, 2. Let's go out further and see if that even has more support as we go further out in time. So down, period of consolidation, came back up, all the way back down, broke through the 200-day. Let's sell, well, maybe either, I could even sell something at the money on this. DG. We're going to go out 44 days. So as part of a normal routine, if I had underlyings that I like to, and I find stocks that I want to sell short put spreads on, normally on a stock like Dollar General would go out 44 days to put that trade on. And so with the stock at 102, you could sell the 100 and get $4.35. 105. I would like to see the one. I'd like to sell right at the money, 102.50. Let's try 5 points here. Yeah, that's not horrible. All right. So we're going to clear this out. We're going to sell this one. And we're going to buy that one. Yeah, getting $2 on a 5-point wide spread. That's a decent amount of premium on that. So 136. You're getting 1/3 the width of the spread. And we're 2.5 points out of the money going out 45 days. I like this trade. This is, I just like solid news, decent news about the consumer, solid guidance. Stock has been beaten up, and you would anticipate after that earnings call that the stock would be a little bit more positive. Stock has sold off. It's down 4% on that solid earnings report, and I want to sell a short spread against it. We're going to do 1-by-1 trade selling, and this is going to be an official paper trade. Gosh, we could get 190, even better. I would go 185. 185. Let's see where the volume and open interest. Got a little bit of open interest. Not bad. Markets aren't horrible. Yeah, we can get this done for 185, I think. So here we go. Let's make this an official paper trade. We'll put this position on. In Dollar General, with the stock trading at $102.30, it's down $3.97 on the day. We're going to go out to the July 17th expiration, which is 44 days away. We're going to sell the 100 strike put and at the same time buy the 95 strike put. We're going to try to get this done for a $1.85 net credit to the account. That's the maximum that we can make on the trade is $185. The max risk would be $5 minus the net credit received, and boom goes the dynamite. Order has been sent. Boom. All right, now inside the portfolio, I'm going a little bit long, but I do need to do something with Netflix, and I think I have Netflix in my own account, and I put on a couple of I put on a couple of covered calls on steroids. I was trying to think of the phrase I used, but it's a front spread on the underlying stock. Now, I have quite a few shares of it, so I did it on half of the position. Looking for a bounce before we get back to the next earnings report. The stock has really been stagnant as of now, and we're hurting on our 90 call. And I've been meaning to do this for a couple of days inside Options Guide TV. We've got 107 days to expiration. I still like the underlying. I still like the stock. So I want to go out. This is trading for $4. I want to roll this position. So I'm definitely going to take it off. And we can roll. I would probably close it and then open a new position. But when the stock got to 90, we should have been out of the trade. If we were trading this as on a daily basis, our rule is that if you have a deep in the money option contract and the strike hits 90, either you get out and you stay out, or you get out and you roll and you try to stop the bleeding a little bit. And you take your loss on your 100 delta call, and then you take your loss on your original call, and then you roll out and give yourself more opportunity. Once again, if you still like the underlying, and I still do like the underlying on Netflix. So we're gonna go. Let's go to the options grid, and let's move this way out. Now let's go to the options grid. Okay, so we got the 90 strikes, sell to close with the September expiration. And we filled that Dollar General. That's what that ding was. Oh, no, that ding wasn't. Okay, Dougal, I came in late. Did you notice the Dollar General? Yes, I did. I did notice the dividend. The dividend, and I thought about bringing it up, but I'm getting a little bit long at Dougal. It does pay a dividend. So the dividend, the stock will go down by the amount of the dividend, which actually helps the price of the put. It helps receive, it's going to be worked into the price. So it could be a part of the reason why we get a decent premium for this, but I don't mind that at all. So here's my thing about selling put spreads and selling puts in general is, what if the risk is that you're wrong? I don't mind buying Dollar General at this level right here inside our paper trading portfolio. I mean, obviously, you got to diversify from some semiconductors. I got some Netflix in here. Netflix is probably my most bullish stock, and I've been wrong ever since Warner Brothers. Well, let's put it this way. I did bottom fish once the Warner Brothers thing went away, bought some Netflix stock, had some Netflix stock in my account. We came inside the paper trading app, and we actually bought Netflix, made money on the stock, but have lost money on our long option that we've had. We've sold a couple of calls on it, so we have brought in some decent premium. We had a trade that was on going into earnings, and ever since their earnings report, the stock has sold off and just kind of been in this bottoming scenario so far. Okay, so if I'm selling a put, I want to sell something at them. I want to make about 5% on that put, because what is the risk if you don't get put to stock? And it's a different way to think of it. I don't like to sell the puts and just say I'm selling naked puts and I'm just going to speculate on it, but I'm usually selling them cash secured, which usually means I want the stock. And there's a risk to selling a put in that you don't get the stock. And that risk means that if I don't get the stock, I need to get something substantial. So making around 5% is a goal if I'm just selling a put outright. Here in Dollar General, inside our trade, the fact that we got a solid width of the spread, that's not bad at all. I like that we're going to pull in $1.80 on a 5-point wide spread. I just like that as a pure speculation trade. But if I really wanted the stock, you're coming close at $100. The math is simple, right? I would like to sell the 102.50. I would like to sell the right at the money option contract, but they don't have it. So I'm going to sell the 100, and you're still going to bring in about 4%. Not bad. Not bad at all. So if the stock runs away from me, I still made 4%. And if you think about doing that, and well, if it was a 30-day basis, right, and you did 5% every 30 days, and you were able to get that type of premium over and over again, you're looking at 60% over the year. So hence the reason why the wheel strategy is popular. Selling at the money options. If you get the stock, that's fine. Then sell a little bit out of the money call. You're going to get less premium on the call. But if you're doing this routinely over and you end up getting 5 or 6% a month just from premiums, who really cares where the stock goes? As long as it doesn't crater, that's why the wheel strategy is popular. But in this marketplace, it's with all the investment in AI, it's hard to do anything that makes sense like the wheel strategy, right? It's just tough. It's if we have a downside, and Barclays came out the other day, and I saw this tweet saying that the AM market's a little bit frothy, and it's kind of like, duh, yeah. Overall, the market is frothy, and the VIX is at 16. And if it starts to go the other direction, I'm thinking, September and October, if we get out to those months and we still keep this type of bullish momentum, those are always months that like to sell off, just the seasonality of the marketplace. And it could be a fairly big sell-off, without a doubt. And it is scary, but it's also scary to not participate. And I am in, and I am going to remain in. I'm going to ride it through the end of the year with exposure to equities and options, and going all in on the market as we head into the end of the year. I like this trade on Dollar General. But yeah, the dividend, as I say, the dividend's 59 cents, so the stock will go down by 59 cents, and that's probably why we're getting a little bit of a better premium, but it's still a very solid premium. So here is my definition of that I've always used: some volatility, some predictability. You got a $100 stock. It's a consumer stock, and then we have it trading at 40 vol going out 44 days. Some volatility, some predictability. This is a great example of a stock that gives you both of those things. Now, the chart doesn't look beautiful, but it does show you some support down here, right around this area, right at the 94, 95 level. If we can get a bounce, but stock comes down, you're hoping that it would bounce off of that level. But I don't mind putting on this trade and letting it run. If it breaks through the 105 or 95 level, then I want to get out. If we get down to 94, 92, 93, and we still got some premium, I would look to try to get out of the trade. All right, I'm long. What was the we wanted to do the Netflix trade. Let's roll this. I need to get this done because I get to the end of the show and we never get it done. September. Let's go out to 2027. Let's look at the 15, and we'll come down to about the 80. We'll go 75 probably. Let's go look at the trading NFLX. 226 days away. That's a 70 delta. $10 we'd be adding to the trade. Let's move it down. Let's go down to a lot of open interest here. 80 is here, 220. Yeah, it's still a decent market. 22 by, decent relative. 2225 by 2250. I'm going to go to, let's do the 77. Let's hit this. 950. Okay, we're selling to close, the 90 strike, buying to open, the 77 strike. The mid price is 950. The market's not that bad on it. It's not horrible. $9.15 by $9.85. Midpoint is 950. That's what I would put it in. That's what I would work it in my actual account. I'm going to do it 925 because I got to make sure this gets executed because I keep forgetting to do it inside our paper trading portfolio. And order has been sent. All right, let's make sure that gets filled. Still want to remain long Netflix, and we learn more from positions that have gone against us. When it hit the 90 strike, that's when this roll should have happened, and we should have captured as much of that premium and get all the at-the-money premium that we could have gotten on the September 18th 90 strike call. We're going to now roll out. We're going to go all the way out to January of next year. We're going to go back down to a 77 delta, not quite an 80 delta. And we're going to keep this position on. That's it for this edition of Options Guide TV. We will see you. Well, this Friday is Fundamental Friday, so we'll be talking about the basics. We're looking at buying calls, the simple delta procedure. We have a fairly decent position in NVIDIA that we've been talking about. We'll be upgrading now and start talking about long call spreads as an alternative. And that will be Fundamental Friday's topic. So stop in if you would like, share with your friends, and we'll see you this Friday for the next edition of Options Guide TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.